Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for January 2018. Well, looking back at the winter market that we've just been through, it was a very disappointing market for crude tankers. If you think back to October at the start of Q4, the quarter actually started pretty well, but then the market weakened into November, and very unusually it weakened into December as well. Usually you almost always get an increase in rates from November through to December as the winter market fundamentals start to kick in. But this year it went the other way. We had a very weak December. It was one of the weakest Decembers for crude tanker rates in many, many years. And there were a couple of reasons, I think, for that. One is, usually you get those winter weather delays coming in during December. We didn't really see a lot of delays this time around, especially in Europe. We didn't really see the big delays through the Bosphorus, not too much in terms of ice in the Baltic. We saw a little bit of fog delays in the US Gulf, which gave a bit of volatility to Aframax rates there, but really not a lot of weather delays. But I think the big negative factor was really on the fundamentals in terms of OPEC supply cuts. And we saw throughout the year that OPEC kept pretty good compliance with the supply cuts that they implemented back in January of 2017. And in fact, towards the end of the year, that compliance got even higher. And I think in December, OPEC was even more compliant with their cuts. The compliance rate was about 129%, which shows they were cutting more than they had pledged at the start of the year. And that's due to a couple of factors, I think. One is that Saudi Arabia and some of the other Gulf countries have been really disciplined in terms of keeping their production down. And secondly, there's been an increase in outages from other parts of OPEC, particularly Venezuela, which saw a really rapid decrease in oil production during 2017. They lost about 400,000 barrels a day of production. So between the unplanned outages and the high discipline amongst other OPEC members, that's really caused a decrease in Middle East cargoes. And that really has a knock-on effect for the whole of the crude tanker segment, because if the VLCCs have fewer cargoes to lift in the Middle East, it forces more ships into the Atlantic, where they're then competing with Suezmaxes in West Africa, and that drives down the Suezmax rates. And then you find the Suezmaxes increasingly competing with Aframaxes in places like the Mediterranean and the Black Sea. So it just has this knock-on effect right down through the crude segments. And that's really been the root cause of the weak rates we've seen through the latter part of 2017 and at the start of 2018. The other thing as well, of course, is that the OPEC supply cuts have caused oil inventories to start trending down, and that's given support to oil prices. And at the start of this year, we saw oil prices going back to $70 a barrel, which is the first time we've seen 70 since 2014. And perhaps more importantly for the tanker market, not only has the crude price come up, but the futures curve has gone into a pretty steady backwardation, which means that the market expects the future price of oil to be lower than the price of today. And so what that means is that if you're a refiner, you're going to want to draw down on your inventories because you've probably got an inventory of cheaper crude oil. You don't want to buy excess crude oil at $70 a barrel, especially if you think the price is going to go down again in the future. So we've seen this big drawdown of inventories, and that's really negative for the crude tanker market if refiners are using more oil from inventory than they are importing. So that's been what's really been driving the rates down in the last couple of months. If we look ahead to the rest of 2018, maybe just take a look at these supply and demand factors. On tanker supply, I think it's really playing out how we expected. Fleet growth was about 5% last year, which is what we forecast at the start of the year. This year, we think that fleet growth is going to drop to about 3%. The order book does start to roll off, especially in the second half of the year. The first half does still see quite a few deliveries, particularly on the Suezmax side. But the second half really does roll off. And at the same time, we are seeing an increase in scrapping. We had about 11.5 million deadweight of scrapping last year, which was the highest since 2012. And in the start of 2018 as well, we've already seen over 1 million deadweight, maybe 1.5 million deadweight, and we're not even to the end of January. So the low freight rates and the relatively high scrap prices are causing more owners to scrap their vessels, which is going to be a positive in the long run. And so we feel fairly comfortable with our forecast of about 3% growth this year and about 2% growth next year, which is a lot lower than it's been in the last 2 or 3 years. So that really brings us to the demand side of the equation. And the one big positive on the demand side is that global oil demand, end user demand, remains really strong. And if anything, it's getting stronger. We've seen some of the forecasting agencies increase their forecast for global economic growth this year. And the oil forecasting agencies are forecasting about 1.5 million barrels a day of oil demand growth, which we think might even be underestimating how strong demand is. So that's a positive, that end user demand is strong. And it also means that it is drawing down the global oil inventories, as I said earlier. When OPEC put its production cuts in at the start of last year, they said that they wanted to bring oil inventories down to the 5-year average. Well, we're almost getting down to that 5-year average level now. And that's being reflected in oil price, as I said before. You know, the oil price going up to $70 a barrel is just a reflection of that tightening oil market. So it really depends what OPEC's going to do from here on in. At the moment, they've been quite disciplined, and they've said that they're going to extend those supply cuts until the end of 2018. But if the oil inventories continue to get drawn down and the oil price continues to find support, then we think that at some point in the second half of the year, OPEC probably will have to start exiting from that supply cut agreement and start bringing more oil to the market, because they probably don't want to overcorrect and cause oil prices to go up to $80, $90, $100 a barrel like it was a few years ago, because all that does is it encourages competition like shale and offshore oil, and it also starts to hurt demand when you get prices that high. So I think OPEC probably when you get into the second half of the year, we'll see some kind of response from them where they'll start increasing production again out of the Middle East. And that's going to be probably the turning point for the crude tanker market, because as soon as that Middle East supply comes back again, it's going to draw all those VLCCs back to the Middle East and lift that pressure on the mid-sized tankers in the Atlantic. And then meanwhile in the Atlantic, we're going to get a continued increase in US oil production this year, which should result in more exports and more cargoes, particularly in the second half of the year, when we expect to see some debottlenecking of the US pipeline infrastructure, which will allow more crude to be exported. So we think that really everything's building up to the second half of the year, where we start to see a recovery driven by both the supply side but also the demand side. So we'll probably have a difficult few months to go through Q1 and Q2. Q3 is traditionally a weak part of the year anyway, but we do see that Q4 is probably the time of the year when we'll start to see this recovery, and that will really strengthen into 2019, because a lot of those strong fundamentals that we see coming at the end of the year we think will carry through 19. So low fleet growth, good oil demand, and higher oil supply from both OPEC and non-OPEC. So that's our conventional tanker market update for January, and we'll speak to you again next month.